Well, welcome to the last webinar of the year for Sharesies. So I'm Brendan and I'm the Australian Country Manager. And we have Scott Phillips with us, a Motley Fool's Chief Investment Officer. And we're going to have a bit of a stock take of 2022 and chat about what 2023 might have in store. And what a year it's been. Scott, I don't know about you, but I started off this year with a head full of hair. So it's been a roller coaster.
Mate. You should have seen me. I looked like Elvis back in the day. 12 months have been a very long time.
It sure has. So we'll try our best to sum up 2022 and then help everyone start planning for the new year. But before we start, click all the buttons. I would just like to acknowledge the traditional custodians on the land which we come to you from today, and they are the Gadigal people of the Aurora Nation. And I pay my respects to their elders past, present, and emerging. I also extend that respect to Aboriginal and Torres Strait Islander peoples here today. And a special shout out to Amy Allerton, who is the artist behind this beautiful art that you see on the screen, which we commissioned and Amy created for us, and it's called The Future That We Grow Together. So definitely check out Amy on Instagram and give her a like. So just to recap, crazy. So just to recap on our purpose at Sharesies, and that's to create financial empowerment for everyone. One way we do this is through our investing platform. There are over 500,000 people across Australia and New Zealand using the platform. We've got over $2 billion of funds under management. And the great thing about that is many of those people never thought they could be an investor. So if you're a Sharesies investor and you're here with us today, thank you so much for being with us. Our vision is to give someone with $5 and someone with $5 million the same investment opportunities. We offer access to New Zealand, Australian and US share markets, and there's no minimum investment, meaning you can buy part of a share with as little or as much as you want. We're also a B Corp. So B Corps are companies that are committed to using business as a force for good. So today we'll reflect on the highlights for 2022 and look forward into 2023. And we'll leave time at the end for questions. So make sure you submit your questions through the Ask a Question button below. Don't leave the questions in the chat, as I might miss them. I've got about 1 million screens going and I don't want to miss out on any of your questions. And remember, the only silly question is the one you don't ask, so don't be shy. And before we start, I just want to remind you that investing does involve risk. You aren't guaranteed to make money and you might lose money that you started with. Any information we provide is general only and current at the time of providing it. If you're looking for help with your investment choices, we recommend talking to a licensed financial advice provider or sign up to Motley Fool to get some interesting information. And we won't be providing any personal advice today or recommending any particular investment. We may talk about companies as examples, but that's not a personal advice or a recommendation. So a bit of interactivity. So we've got lots of people on the call today who might be at different points in your investing journey. So welcome. And to break the ice, let's start with a bit of a question. So I'd love for you to have a think about this and then put your answers in the chat. So that question, what has been your biggest investing learning in 2022? Give it a moment. My biggest investment learning is don't open my Sharesies app 3 times a day because the market goes up and down. So it's stick with long-term investing. So we've got invest small amounts.
While we wait, Brendan, do you want me to throw mine in?
Yeah, why not?
Just a reminder that those things that aren't possible are still possible. I'm a little bit older, as you can tell by my lack of hair. And for 35 years, they've been telling us inflation was dead. Turns out that's probably the best idea. So yes, when someone says something can't happen, assume it can still happen.
Yeah, that's a good point. So every little bit helps, focusing on ETFs rather than picking company stocks, weather the fall in value, buy when everyone else is selling, diversification. Don't look too often. Yep, Shelley, I agree with that one. Cool, there's lots there. So as from the comments and just when we started off, everyone knows that 2022 has been a roller coaster, and we undertake some quite regular investor surveys. So if you've been part of those surveys, thank you very much. It gives us really great insights into what's going on. And from this graph, you can see we had an investor survey in Q2 this year and then Q4, and we've seen spending habits fluctuate. So post-pandemic spending, and I still don't know if we're in a pandemic or not, but post-pandemic spending was getting back on track earlier in the year. And we asked, what you were going to spend your money on, and people were like, holidays and investing. We'd been locked down for 2 years. There was that kind of revenge travel narrative that was going on. But now nearing the end of the year, we've seen living expenses take the top spot for the number one expense in the next 3 months. So I know we're probably all feeling the pinch. I've had to redo my budget a few times this year, that's for sure. And then investors are also telling us that they're looking to increase savings over the next 3 months. So Scott, some questions for you. Is this what we're seeing happen in the broader market? What are some of the key moments in 2022 that have influencnced this approach to kind of spending and investing?
Yeah, great. Look, I mean, I think we all know what the last 12 months has been like. Whether you are whether you're at home, you've probably been most impacted by increasing mortgage rates, but all of us have been impacted by rising inflation and rising prices. And I think what comes with that is the broad concern of what might happen next. And I'm not surprised to see that a lot of Sharesies members have got a massive increase there in expectations for saving, for example, the whole idea of the rainy day thing. What I love about the increase in saving, though, from people who've answered this survey, Brendan, is that, in fact, the savings rate in Australia has been coming down pretty much consistently since the worst of the pandemic time. So kind of talk about July, August, September, October of 2020, we saw national savings in Australia at over 20%. It's over 20% of our income was going straight into the back pocket, into the bank, the kind of rainy day saving. But that's been spent away over time. People are feeling better about spending. That number's come down. I think 6.9% was the most recent one. That's almost back to the long-term average in Australia. And so while that's come down, we've got Sharesies respondents saying, you know what, I'm going to save more money as we go forward. That's a really, really cool thing to see. So I think we all know that whatever you do it now. So starting to save, starting to invest, but also continuing to do that where you can. And we know things are tough. And there are some people I'm sure watching who are saying, hey, I'm more and more of my money is going into the mortgage or going to the rent or going to the petrol pump or the cash register at the checkout. Those things are absolutely true. But those who can continue to find ways to save and invest, I'm pretty sure, again, no guarantees, no promises, but the long-term history of the share market suggests that the more quickly, earlier, and more consistently you can add money to the share market, the better.
Yeah, and I've got your favourite chart here. I know this is one of your
good man.
favourites, a Vanguard index chart.
I'm a hopeless fan of this one. I have no dog in the fight. Vanguard is, of course, an investor-owned institution, so I couldn't own shares even if I wanted to, and if I wanted to, I probably would because it's a pretty good business. But I love this chart. I'm all over this chart. Presented it at the Shares Club meeting we had in Sydney. A while ago now. I don't remember when that was, Brendan. You might remember. Look, this is the mothership chart. This is the chart that is the reason why. This is the one that tells you about the value of long-term investing. Now, I figure if you're a Sharesies customer, you know this chart, you know the power there because Sharesies does a wonderful job. By the way, I don't own shares in Shares either, but maybe we can talk about that one. But you guys do a fantastic job, and I'm sure your customers and members are really, really happy. They've listened well to the messages you guys have been sharing about the value of long-term investing. Because here's the thing, we talk about the last 12 months, and it's been a really, really crazy last 12 months. We know what a big deal it's been. We know how much has changed. We know, how much people have been rocked by higher prices, higher mortgages, all the stuff, energy prices, man. We've talked about all that kind of stuff. And that sort of thing happens, right? What's important about this chart is it covers 30 years of history. And so you think about all the reasons for panic and worry, and actually even the real reasons, right? So COVID, by the way, is in this chart. That's the remarkable thing about this. Now, 10 grand in Australian shares, $130,000 over 30 years. So a 13-fold increase in the value of your Australian shares, despite everything that's gone on in that 30-year period. And that's, if I could get one thing in everybody's heads, this is the one I'd be passionate about. If I could only have one picture and one conversation with investors, this is literally the one. This is the one that puts everything else in context. Imagine what happened during those time periods. There have been just phenomenal movements in macroeconomics, in geopolitics, in everything, expectations. The dot-com crash is in the last 30 years. The GFC is in the last 30 years. The COVID crash is in the last 30 years. If someone had told you in 1992, hey, this is all the stuff that's going to happen. There's going to be a massive tech crash. Then there's going to be, an almost freezing of the global economy, the subprime crisis, the biggest recession since the Great Depression. Then, by the way, we're going to have a once-in-a-century pandemic, and that's going to be terrible too. That's what's going to happen in the next 30 years. So maybe don't invest. You would have said, oh, gee, thank you, man, you've saved me from making a big mistake here. Except, as I said before, we already know that over that same 30-year period, there was a 13-fold increase in the value of shares. Here's the other thing quickly too. That 30-year return of about 10%, I think it's 9.6%, is pretty much within a couple of percentage points, the same return over the long term since the early 1900s. So you've got this story of people say, yeah, well, it's just the last year. Yeah, it's just the last. If you want to find a reason to dislike this chart, then do your best, because the last 30 years have been wonderful. The 70 years before that were wonderful and not dissimilar in terms of the total return you can earn. So if I feel like I'm passionate about this, I hope it's coming through. I absolutely am. Your future self, I'm reasonably sure, again, I can't make promises or guarantees. It'd be inappropriate, unethical, and frankly illegal. So I won't do any of those things. But I don't see any reason why the next 30 years be anything different to the last 30, the last 100, the last 100. And I think 1906 is the data that Credit Suisse has got showing these sort of returns. So I just want to really impress on people the value of this. And just quickly, Brendan, the reason why is people, businesses, innovators, disruptors, entrepreneurs find new ways of solving new and old problems. They always do. That's been the story of human ingenuity for the last, goodness knows how many 100 years. And, to imagine that maybe we've all of a sudden reached peak humanity, peak technology, peak commerce, peak whatever those things are. I think that's a gutsy call to make. If you think it's never going to get any better than we have it today, and therefore shares aren't going to go up, I think that's a really gutsy call, because the past is all about people finding new and better ways to do everything from the production line through to the iPhone, from through to computers and that kind of stuff. This is a fantastic story of human ingenuity. Doesn't mean the society is perfect, doesn't mean our system is perfect, but just be careful when you think about our chances of what the future might look like. The iPhone is 15 years old? We didn't have iPhones 15 short years ago. Now, if you're 25 and listening to this, you probably can't remember being younger than 10. You've had it for your whole life. But trust me when I say 15 years is not that long. And the fact that it's indispensable now compared to the fact it didn't even exist 15 years ago is a reminder of what can be achieved by people who have the motivation and interest to do it, and the sort of gains we can capture as investors by being part of that journey. You
love this chart. If you're going to get a tattoo, I'll get a full back tattoo of this chart.
I may. Well, you never say never, Brennan. Not planning on it, but I could be convinced. I could be persuaded.
And this just shows how resilient markets and economies are. Yeah. And it does changes in technology and global pandemics and wars and everything. Yeah. It's like the market. This is why this market moves in cycles. Bull and bear is just a kind of a natural thing in the market.
Yeah, absolutely.
Right, so if we just go on to the most popular investments in 2022 for all the Sharesies investors. So obviously we know the tech industry took a big hit in 2022, worsening market conditions, and that impacted growth companies, which tech really is. It's future-based growth that we value them on. But we still saw Tesla amongst the top most popular investments by value in 2022, along with a couple of index ETFs and some mining companies. So nothing too surprising there. And then if we look at the top investment buys by the number of investors, the top 5 for 2022 are all exchange-traded funds or ETFs. So what this kind of shows us that when the markets are a bit turbulent, people do tend to stick to investments which are more diversified. So we know ETFs provide a big diversification managed by fund managers who look after that stuff. So I know the answer to this question, Scott, but does that surprise you? Were there any other kind of investments or themes that this year that you thought were kind of popular? And then what do you think the market conditions have kind of done to this? So big questions, but
yeah, but good questions, mate, and important questions, because as we kind of finish off 2022, it's an understatement. It's been a hell of a year, right? If you think about where we started the year, there was some sense that maybe there was some inflation in the US at the time. The Americans thought, well, maybe it's transitory. And we thought, well, maybe it's just an American problem. Now, by March, we had a big issue. And by May, rates started to go up. So this is a really, really big year, and a year that changed quite quickly with lots going on. No, none of those surprised me. And I'm really, really impressed with the number of ETFs, for example, that are owned by your investors, because it is a fantastic way to build a cornerstone. Look, I will say, man, I'm a stock picker by trade, right? My job at the Motley Fool is to pick stocks. But firstly, I own ETFs. Secondly, I love ETFs. And one of the great things, I'll give my company a plug for a minute. One of the great things at Motley Fool is they let me go and say, hey, ETFs are great, even though, we make our money by trying to help people beat the market. Being the market, getting the market return is just spectacularly good, and is such a great way to take a diversified one-click approach to getting some of these sort of returns. So they're great businesses and great ways to go. So some really key themes here. Some of that ESG stuff, the clean energy there, climate change innovation, ESG leaders, man, 4 of the top 5 have a really clear theme. And I think it talks to probably the demographic of your investor, but also the changes that we're seeing in the way people are investing and how they're using their money to try and affect change. So that's really, really important. And then, as you say, on that investment by value, just simply makes sense, right? BHP, largest company in the ASX, of course, is going to be there. Tesla, the most popular and even bigger, US tech company. Again, no surprise there, just because even on a index tracking level, those two should be there or thereabouts for investors. And of course, Tesla, one of the hottest stocks in a very, very long time, and one that really grabs people's attention. So no big surprises there. Really, really excited to see it. I love the S&P 500 on there. Love the Australian shares ETF on there as well. I own the Australian Shares ETF for the record. So just to put that out there, full disclosure. But yeah, no, really, really great things to see. I think it's exactly the sort of thing we're seeing right across the market. The really key interest in ESG investing, climate investing, ethical investing, call it what you will. That remains a really, really important thing we're seeing across the market right now. We're seeing a whole lot of people try and find ways to put money to work in ETFs. The sheer growth in passive investing globally is huge. The fund flows, there you go. The fund flows for passive investing. That's a remarkable chart, right? So there's actually net money coming out of active investing over the last 2 years. Now think about the growth of the world economy. Think about the amount of money going into retirement funds right around the world. Here, superannuation, the US 401ks, all that kind of stuff. This is US data, so take that for what it's worth. But there's actually not growth in active investing, but money coming out of it, and more money going into passive options like the ETFs you just talked about. So it's really, really, it's great to see. I think, so look, there's 2 things here. First is, if you're an investor who doesn't want to pick stocks, ETFs are spectacular. Keep them low cost, make sure they're broadly diversified, preferably index-based as ideas. So think about that. Don't pay too much. Just check your management fees for ETFs if you're going to buy them. But they're a fantastic way to either build a super low involvement portfolio, just put aside some money, keep doing it regularly. In 10, 20, 30 years, hopefully having a lot more. That's a spectacular way to do it. So there's that. On the flip side, I would say too, though, if you are someone who wants to buy individual shares, and we saw plenty of those on the left-hand side of that previous page, Brendan, there's some great opportunity for individual investors, right? Because there's less money, literally less money, and a lower proportion of investment money chasing some of those investment opportunities. And so there are and do remain, I think, for those who want to do that, want to take that risk. And as you said at the beginning, individual shares are riskier than ETFs by definition, or than index-based ETFs anyway. But if you're going to do it, there is, I think, plenty of opportunity to do exactly that and to find some businesses you like that you think are going to be great investments, because the market is thinning out. The competition is thinning. More and more money is going to passive, which I think is, again, spectacular. But it does mean if you're a stock picker, if you want to buy individual companies, you have more of an opportunity to, I think, have a look in there, use a bit of nous, use a bit of time, do a bit of research, and maybe find some winners as well.
Yeah, like our Sharesies investors, on average, have about 3 ETFs and maybe 2 or 3 companies, and they're companies that
that's cool.
I invest in companies that I know the products. I think management is great. I think there's a future for them, and some of them are looking a little bit on sale at the moment. So so it's good times. Also on the ESG bit, we've done a previous webinar on that. So if people are interested in a bit more detail on that, there's absolutely a lot of money is flowing to go with values, and you can pop onto our YouTube channel and have a look at that. And then in our investor surveys too, we kind of talk about how you're feeling. So in the latest investor survey, we found that 80% of investors weren't really worried about the investments over the next 6 months. So that's really heartening to know that most of our investors are in it for the long term, and we understand the ups and downs of the markets, and there's no panic selling or anything like that, which is great. And so then 2023, Scott, crystal ball out. How are you feeling about it? What predictions do you have? No pressure. This is what everyone's come for. What can you tell us?
I can
Put your favorite slide back on to get some context.
Yes, no. Well, let me start with a quote from J.P. Morgan himself, not J.P. Morgan, the investment bank. J.P. Morgan, John Pierpont Morgan himself. When he asked what the market will do, he gave the very best answer. He said it will fluctuate. So that's my prediction for 2023. There will be volatility. There will be fluctuations. These things will happen. Now, look, I have a line. I think I probably told you this one before, mate. That if someone makes a prediction and they think they know what's going to happen, they are lying to you, or they're lying to themselves, or maybe both. The simple reality is that no one knows what's going to happen next, and it's a very simple test, right? In November of 2019, who said the market will crash 38% in February and March 2020? The answer is obviously no one. And you might say, that's unreasonable. How could they have known that was going to happen? To which I say, exactly. That's precisely the point, right? So don't try and predict. That honestly, my prediction is people are going to keep predicting. But my advice is don't try to predict what's going to happen next. Now, again, what I love about talking to Sharesies investors is they get it, right? So they're not trying to time the next day, week, month. They're not trying to work out which share is going to go up a couple of percentage points by Friday. These are largely long-term investors doing it the right way. So I think that's spectacularly good. So hopefully I'm preaching to the choir here. But what I would say about 2023 is a bit like I kind of talked about 2022, is prepare for what's likely to be a bumpy ride. And I say bumpy ride economically, but also on the market, because we simply don't know what's coming next. But there are some reasons to be a little bit mindful of a range of potential outcomes. We know that national saving, I've already said, has declined. And that's something that means at some point, if that goes negative or at least goes meaningfully lower from here, there's just less money around. There's money going to be spent. If we do continue to see the RBA raise rates, if prices keep going up, it puts more and more pressure on discretionary spending and on economic output in general, GDP, economic growth, call it what you want. And that does raise the risk of a potential recession in Australia over the next 6 months. What I hope, and you put the chart back up, Brendan, which I appreciate, what I hope that I can also say to people is I have a prediction over the next 30 years, which is it's probably something roughly like the last 30. Now, let's say I'm wrong. Let's say it's only half as good as the last 30. Okay, your 10 grand only becomes $65,000, which frankly would be a really, really, really good result. And so that's kind of what I want to make sure, don't miss the forest for the trees. People are so desperately trying to get the little things right and maybe missing the opportunity to just get the big thing right. And I'm not going to have any new, points to make versus what I made before. It's a revisit of the same thing, which is just don't focus too much on who cares whether you get 2023's predictions right. Now, I'll give you an example of a company that I like. It's not a recommendation, as you say at the beginning, Brendan. So keep this in mind. I don't own these shares either, by the way. I'm using it as a single example. JB Hi-Fi, the company, was trading on a PE of the price-earnings ratio of something under 10 a while ago. I'm not sure if it's over 10 now, but it's kind of there or thereabouts. It was 8.8 at one point. Now, people are doing that because they're saying, well, hang on, the next 6 months might be rough. And I think, you know what, maybe they might be right. Maybe even the next 12 months is rough. I don't know, but maybe it is. Let's actually even say it is. Let's say there's a recession over the next 12 months, and let's say the economy shrinks by 2%. Really unlikely, but let's say it's possible. And let's say JB Hi-Fi sales fall by 10% as a result. And let's say maybe that means their profit halves. Let's pick some numbers, right? So their profit halves, and therefore their PE goes from 9 to 18. That's the way the maths works. And they look expensive for a year. Now let's go out another 4 years. The recession's over. Growth comes back, the economy recovers, JB Hi-Fi ends up more dominant even than it is now because some of its less well-capitalized competitors go broke. People find new ways to buy new electronics. Apple invents more devices, Samsung, Google, everyone develops more devices. And in 5 years' time, it's pretty likely, I reckon, JB Hi-Fi has got higher levels of sales than it does today and probably higher levels of profits than it does today. And if that's true, and you look back to 2022 and say, I could have bought that then for what price? Man, that was cheap. Now, I could be entirely wrong about the example or even about the overall trend, but my broad point is businesses that are going to be meaningfully bigger and better in 5 and 10, 15 years' time, it doesn't matter what happens in the next year. It's just completely irrelevant. As long as they make it through without, A, going broke, you need to make sure they're not going to go broke, so careful of debt, and B, if they're businesses that are going to be able to maintain a lead in front of their competitors, whether it's product or price or brand or cost or something, whatever separates them from the rest. The best businesses tend to keep getting better. And so I think that for me is, the prediction is that people will keep predicting, but my advice is don't try to predict and don't get caught up in what might happen next. Because through all of those times, again, that graph, through the .com crash, through the GFC, through the COVID crash, And whatever the next crash is, there'll be another one, by the way, in the next 10, 15 years, almost certainly. Again, no promises, no predictions. But that's just happened. Cycles happen, right? And so getting to buy at the bottom of a cycle or near the bottom of a cycle is great. Morgan Housel, the great finance writer, says, in hindsight, every crisis looks like an opportunity. At the time, every crisis feels terrible. And those things are both true at the same time.
Very good. My predictions are that I will not be listening to any of my aunties at barbecues about what companies to buy, because I agree. It's like, just keep looking, value, auto invest every week. That's just what I'll do.
Absolutely, mate. Yeah, totally, 100%.
Cool. So speaking of Christmas, it is 12 days until Christmas. So if you haven't bought anything for your significant others, loved ones, next door neighbours, anyone, we've got something for you. So before we say goodbye to 2020, Christmas 12 days away, and if you're in some need of some last minute gifting inspiration, we've got some gifts for you, some Sharesies gifts. And that can help someone start or build your investing portfolio. So perfect for Secret Santa at work or for a friend or a family member. You can give Sharesies gifts to both people who already have an account with us or they would like to start. So here's a little demo from Melissa just to show you how easy it really is.
Gifting this holiday season doesn't have to be so hard. If you've got a friend who's just gotten into investing or has been thinking about it for a while now, then a Sharesies gift may be a wonderful surprise to support them on their investing journey. Here's how to grab one for $5, $100, or any amount up to $2,000. If you're on the Sharesies platform, head on over to the Account tab.
Whoops. Let's start that again.
Gifting this holiday season doesn't have to be so hard. If you've got a friend who's just gotten into investing or has been thinking about it for a while now, then a Sharesies gift may be a wonderful surprise to support them on their investing journey. Here's how to grab one for $5, $100, or any amount up to $2,000. If you're on the Sharesies platform, head on over to the Account tab, share the love, buy a gift voucher, and from there you can simply click buy a gift, or if you're lucky, redeem a gift. If you're already on the Sharesies platform and want to buy a gift, click buy gift, choose the gift voucher amount, pop in your details, and click review gift order. If you're not on the Sharesies app yet or prefer to purchase on our website, head to sharesies.com.au and then click the 3 lines on the top left-hand side, gifts, buy a gift, then pop in your details, your first name, and your email address, and then your gift amount. Pop in your card details and tick the 2 buttons once you've understood. Once purchased, you get your Sharesies gift in your inbox within minutes. Send it to a friend or maybe just keep it for yourself.
Thanks, Melissa. So it's been a massive year for us at Sharesies, and we've loved going around the country and meeting lots of the Sharesies family at events like our Share Clubs and Ladies Finance Club Roadshow, and hosting our first series of webinars. So we'll do more of this in 2023. And to name another couple of highlights, we launched 2 new podcasts, Unlike the Investors and the Sum of It. So if you like the sound of Scott and my voice, you can listen to the sum of it and you'll get more of it. We're also now on TikTok, so give us a follow if you haven't already. And we celebrated our favourite fruit for Pineapple Week. We're thrilled to be the CanStar Innovation Excellence Award winner. And we've got some exciting new product features coming in 2023, but I'm not going to give any of those away today. But we've also invested in making the experience great for you. So there's a feedback form in the app, and we'd love all of you to pop in your ideas of what you want to see in 2023. And so you go into the app, you can find it under the Accounts tab. Just scroll down to request a feature under the support heading and let us know what you want. If you haven't joined up to Sharesies already and you're ready to start investing, we've got a promo code for you. So if you just use the promo code webinar when you sign up, you'll get $10 in your Sharesies wallet ready to invest. Now for the fun. This has been fun already, Scott. So
you were about to say now for the fun part, right?
Yeah, now for the really fun part,
yeah.
which is all your questions. So come up with some great questions. The better they are, the more Scott will squirm, and that'll be a great way to end the year.
Hey, while you're waiting, Brendan, I will say, mate, I have opened during the year, only in the last couple of months, actually, a Sharesies account. Not because you guys asked me to or paid me to, just because I wanted to, and you do a great job. For my young bloke, he's already using the platform to choose his own shares. You've got a little bit of money there for him at the moment, but he's getting the hang of buying individual shares in individual companies. I'm actually going to, hadn't thought about it until now, I'm going to throw a Sharesies gift into his account for Christmas for him. So there you go.
You're a nice dad. And
exactly.
do you think his picks are doing better than yours?
So you know what I love about it, mate, is so there's two ways to really quick vignette. Two ways to get kids into investing. One is to try and build their portfolios as much as you can, just by investing in the best things for them. The other is to help them build a love and an interest in business. So I've actually taken, I've got some other money for him. We're investing for him, but we're getting this bit of money to do for himself, right? So I just said, what do you want to buy? And the idea was just like, what is a share? What does it mean to own a business? God love him. He loves his cars at the moment. He's 9. And so he actually does have shares in Tesla via the shares. So he's one of those on the left-hand side of that chart you showed before. He's one of those investors who bought bought shares in Tesla, and he just loves Tesla. He thinks they're really cool, and that's enough for me at this age of just like, I own shares in Tesla. That starts the conversation, keeps the conversation going. It makes him feel like an owner of a business. He kind of starts that journey. So right now, they're probably not doing better than mine, actually, honestly. I think Tesla, since he bought it's probably down a little bit. I actually really don't care. I mean, I want him to make some money so he gets the idea of actually why it's worth investing, right? Because things go up. But for me, it's that combination of the investing bit, but also just what it means to be because investing is part ownership of a business, right? It's not trading shares on a screen. Again, your investors know that. But the idea of I own part of Tesla. Every time you see Tesla drive past, you own part of the company that made that. You know, whether it's Woolies, you own part when you go to Woolies, or jump on the phone with Telstra, own Telstra shares. You know, you're using that service. You're making a little bit of money every time we shop at Woolies. That kind of stuff. It can be really powerful as kids learn about investing.
Yeah, great. My nephew's the same with Disney and any toy companies and
great
stuff.
example.
It's like, too much Lego in that household, but I'm like, we'll keep buying it. You might get a dividend. Cool. So we've got some great questions coming through. So
awesome.
Let's talk about, how do you know if you're paying too much for an ETF? And also a kind of question which attaches to it, which is like, what's the difference between active and passive investing?
Oh, cool. Okay, let's do the second one first. Passive investing means you are just letting the market do the work. You're choosing an investment that tracks a particular part of the market. The easiest one to use is the one we had on the screen before. If you buy shares in an ASX ETF, an Australian Stock Exchange ETF, you are just getting the stock market's return. That's why it's passive. You're not choosing which stocks to buy, in what proportions, when to buy, when to sell. You're saying, you know what, I just want the return of the market. And that's passive investing. Active investing is when you're choosing the stocks specifically. I don't want the whole market. I want to buy BHP and Woolies and Commonwealth Bank and News Corp, just to pick some numbers, right? Or Tesla and Apple and Facebook. So you're choosing individual companies to try. That's active. You're actively choosing, versus passive, you're getting the passive market return, or the return of a sub-index, like an ESG index or a clean energy index, for example, that we saw before on the screen. So that's the difference between the two. In terms of paying too much for an ETF, there's a thing called the management fee. The Australian terminology and the US terminology are slightly different, but you'll get the idea. You'll find it somewhere. The management expense ratio, the management fee, you'll see it called different things. And that'll be expressed as a percentage of the fund's value. Now, depending on what index it is, in which countries, and how difficult or easy it is for the fund manager to buy those shares, it can be real. I think the lowest one I've seen is 0.03%. I'm pretty sure that's the Vanguard S&P 500 or total market index. Tiny. That's like, was it 30 cents for every $1,000, something stupid. Really, really small. On the other hand, you will see some that are more than 1%, and that might be I don't know, the Botswana and clean energy and oil index or something, right? And so the harder it is to get to that market, the more you've got to pay, the less liquidity, the fewer people are investing in it, the more you have to pay. The best thing to do is, if you find an index you like, you want to track, if you want to track the ASX 200 or 300, for example, then find the ETF providers that do that index and simply compare those providers. So you want to get the cheapest price you can for the investment strategy you want to follow.
Yeah, and in the Sharesies app, you can go to the ETF and there's all the fees there, and you can click through the website.
I didn't know that. Well done.
And some of the ETF providers, some of the fund managers do an active ETF, which means they are actually doing that choosing for you. And sometimes those prices are a little bit more versus a passive one where it's just kind of set and forget almost. But absolutely do your homework, because over time, and we're investing for a long time, like a small difference in fees can make a significant change to the outcome.
Huge difference, absolutely.
Here's a good question, and I wish I knew the answer to this one. If a stock price is going down, how do I know when to sell? If it's never going to turn around, what do I look out for?
Okay, so if a stock price is going down, it'll either keep going down or it'll start going up. And I say that absolutely flippantly, but absolutely seriously. don't assume the chart can tell you what's happening next. There are people out there who will say you can do it for that purpose. I fundamentally disagree. You can choose to believe me, choose to believe them. Maybe I'm wrong, maybe they're right. I'm just saying from my view, I've never, ever used a chart to determine whether or not to buy or sell shares. I used the example of JB Hi-Fi before. Whatever happens over the next 12 months will be almost certainly irrelevant in terms of where the share price will be in 5 and 10 years' time. Because over time, price tends to follow value. In other words, the profitability of a business. In the short term, it's all about the sentiment of the market. The market loves this, hates that, loves this, hates that. Fine. But eventually, it's hard to hate something long enough if it's making more money. It's hard to love something for long enough the share price keeps falling. So don't just use the chart. So I can't tell you when to sell based on whether the share price is falling or not. What I would say is, for me personally, I would sell something when I no longer believed in the company's quality, when I thought there was a better place for my money. So straight out, I thought this was a good business. I still think it is, but that one over there, it's even better. I need to free up some cash to do that. Or if it's significantly overvalued. And so that's a harder one to tell because a business can keep growing, it keep declining. AMP went from $20 to 10. Gee, it halved. That must be good. And then it halved again to 5, and halved again to $2.50, halved again to $1.25, and I might have even halved again at one point. So a falling business can keep falling, but it can also turn around. Amazon has fallen 50% or more 25 times in the last 25 years, based on numbers I saw the other day. And yet it's up, I don't know how many 1,000% from the 1997 IPO price. I own shares in Amazon. So don't take the past and look into the future. So those are the reasons I would be selling. If you look at a company and say, hey, this thing's a dog, it's never going to recover, I think it's going to recover. It's a pretty good chance that you're better off putting your money into something you have more faith in. Do you think represents better value for you as an investor? If the answer was obvious and easy and calculable, we'd all be millionaires because we could all do it. It does, unfortunately, involve some judgment, but those hopefully are a couple of pointers to try and think about the times it's best to sell, not just because the price is falling. Again, take the Amazon example. If you'd have sold that after any of those 50% falls, you'd have lost a small fortune or maybe even a large fortune subsequently. So don't sell just because it's falling. Don't buy just because it's rising either. Ignore what's happened in the past is my best advice. Look forward and say, hey, is Amazon going to be a bigger and better business in 15 years' time? Is AMP going to be a bigger and better business in 15 years' time? Is Tesla going to be bigger and better in 15 years' time? And by the way, try and find some conviction and some reason for having that view. Don't just say, oh, I think so because I just think so, because I like the company or I like the business or I like the products. Make sure you think there's a reasonable view as to why everyone else will like them as well and why the company will make more money. But if you can get to that point, you're in a pretty good place to start making a decision.
I think I've kept one of my worst performing investments just as a reminder. And
that's not a bad idea.
An interesting story of like, oh yeah, that's cool. That's down 80%.
Made a bad mistake.
It wasn't much money.
Yep, we've all got those.
And then we've got a question about investing in, say, the index, say S&P 500 or ASX 20. Just like, are there options for that on Sharesies? Are you only available for the fund providers? And I think this is a question about what an ETF is. So if I just go back, an ETF is like a basket of securities. So on the ASX 200 ETFs, they contain a little bit of every one of the top 200 companies on the ASX. Now you could, if you wanted to, buy 1 cent of each of those companies on Sharesies, because you can buy 1 cent of a share. And then you would effectively have the ASX 200. Your Sharesies app would look very cluttered and I like a nice clean app, but you could do that. And so the thing with the ETF providers is they already do that for you and you just buy it in one instrument. There is a discussion about when searching the app, just the Vanguard options come up. You can search, there is a great search function in Sharesies, go to ETFs and then pick the different markets and that will show you all the providers. So there are other providers of ETFs in the market that can do that for you and then have a look at them. Some are a little bit different, some have other fees. So ETFs are a really good way of kind of getting that diversification. Cool, this is a good question. A bit predicty, but I think based on previous outcomes. So what normally happens to share markets during a war? There is a little bit of a, what's going on. There is some geopolitical stuff at the moment, which is creating a bit of tension.
So I will tell you that the US Dow Jones index, which was their preeminent market index, during World War II, actually ended 1945 higher than it started in 1939. And so I think what I think is really, really important, Brendan, this is a really great question because it goes to what can we reasonably know and what can we reasonably do about it. By the time everyone already thinks something to be true, the share prices will have already reacted to that thought even before the thing happens. So I'll give you, the COVID crash is a fantastic example. If you'd known in December 2019 what was going to happen, you could have sold all your shares and bought them back in the middle of March at a 40% discount. Now, that's a pretty attractive idea, right? A couple of problems with that is no one knew in December what was going to happen during 2020. The other is when the market's down 40%, very few people have the confidence and the guts to actually buy the market at that point. Imagine if you'd sold, pick a number, 10 grand worth of shares, your entire portfolio in December 2019, and then someone says to you, after the market's fallen, it was 38% the ASX, after falling 38%, was now's the time to put your money in. You're like, are you crazy? The market's falling. COVID could be terrible. This could all be horrible. I'm not going to invest now. What, am I, an idiot? And then, of course, the market rallied really quickly. It was the fastest bear market. So that's a market that falls more than 20%. Fastest bear market, then the fastest recovery in history. So not only did you have to have the guts to do it at exactly the worst time, you had to do it really, really quickly because the market recovered really fast. So that's the first thing. Second thing is, when was COVID worse in terms of number of cases, hospitalizations, and deaths? It was actually later that year after the market had recovered. So not only did you have to have the guts to buy when the market was low, that was before things actually got bad. And so let's take the war example or something else. By the way, commodity prices are already sky high. We already have had economic slowdown. The market has already fallen meaningfully. The Nasdaq's off 30% in the US, the US technology index. The US S&P 500 is down at 18%, I think, and the All Ords off, the Australian market's off about 7%. So those things have already happened. So you say to yourself, now what do I do? Now, I don't know what happens next. But what I would say is if you think about the analogy of the COVID crash, for example, the bad news is probably already priced in before it happens. And the recovery then happens. Here's the other part about the COVID crash. Airline stocks had rebounded most of the way before a single plane got back in the air. At least, well, there was always a few planes, but you know what I mean? Before travel was allowed again, the airline stocks, the travel stocks had recovered most of what they lost. Why? Because people saw it coming. If you waited until the announcement of, hey, it's okay, everyone, you can go back on the planes now, you'd miss the opportunity to get that upside. So it's tempting to want to say, I will sell at the beginning of a war, buy back at the end of the war, and everything will be great. The reality is the market's probably going to fall before the bad news gets worse, and then it'll probably recover before the bad news goes away and the good news returns. That's what markets are supposed to do. They're supposed to be forward-looking. So just be really careful about trying to think you can somehow use those macro events, the news flow, all that kind of stuff, to pick good buy and sell times. It's really, really, really hard to do. In fact, in all probability, I would suggest you're probably better off, not every time and not all the time, probably better off actually being contrarian and saying, hey, when the news is worst, very good chance it can't get much worse. It's probably going to get a lot better over time. That was the .com experience. That was the COVID experience. That was World War II, et cetera, et cetera, et cetera. So just keep that in mind. Don't assume the market will follow line for line the economy or war or pandemic or anything else.
Yeah, and I think also with wars, disastrous effect on humanity, but
Yes.
Particularly when you're looking at diversification globally, if you look at the ongoing conflict in Ukraine, horrible, but supply chain issues have shut down, and commodity producers in Australia have got better prices than usual. So diversification globally also kind of helps with that.
Yep.
Got a question via social.
Excellent.
Nice, easy one. What are the benefits of non-dividend shares?
Fantastic. So you can get returns. The money doesn't care who owns it or how you make it. All it cares is it's there, right? So getting a dividend is wonderful. I love dividends when they come in because they come into my account and go, hey, I made $100 or whatever it is. And I feel rich and I feel like I've made some money and life's pretty good, right? It's always nice. When the cash turns up when you haven't worked for it, that's pretty cool. But you can also make money by share prices going up. Now, I'm going to ask you to imagine two different bank accounts. One bank account, when it pays you interest, you get so let's say they're term deposits. For those people who've got term deposits and know about them, you got two term deposits. One of them pays you that interest every single month. So every month you get the money that gives you money, more money, more money. Oh, hey, I'm getting money. This is great. This is a dividend paying business. It's an interest paying bank account. The other one doesn't actually pay you anything out. The money stays in the bank account, and then your money makes money and makes money and makes money. In the business parlance, the analogy there is a business says, I'm not going to pay you a dividend. I'm going to keep that money and I'm going to reinvest that in future growth. I'm going to get bigger and better and badder because I retain those profits. I don't pay them out as dividends. I keep them and I use that money to find new ways of growing my business, earning more revenues, earning more profits, getting bigger internally. And those two things can even be the same amount, the same percentage return in some cases. It's how the money is distributed or not distributed and what the business does with it. Now, a business that keeps the money, doesn't pay you dividends, can also waste that cash, by the way. So there's no guarantee just because there's no dividends, you're going to do really well. There's some great non-dividend payers that have also then gone broke. So it's really, really possible. I'm not suggesting, again, that anything is definite in either direction. Dividends are great because the cash comes out. You get to use it. You get to reinvest it in your own account. If you get companies that don't pay dividends, in theory, if you like the business, they're doing a good job, they're keeping that cash, they're using it to grow the business, make it bigger and bigger and bigger. And again, I'm sorry to go back to it. Amazon's just an easy example. It hasn't paid a dividend, I don't think ever. And in 25 years, it's grown a compound growth of 20% per year in terms of sales for 25 straight years. So if it had paid out some of that dividends instead, could it have reinvested in new distribution centers, in new staff, in the Amazon Web Services business, plenty of other business. Berkshire Hathaway is another great one, right? Warren Buffett paid a dividend in 1965 and then never, ever since. And his returns have been spectacular because he kept the money and said, I'll use that money. I'll go and buy other shares. I'll go and buy other whole businesses. And those profits will come back to us as shareholders. So the benefit of not paying a dividend is getting to reinvest that growth internally inside the company. The CEO has more money to go and create more value for you. And in theory, that will lead to a higher share price. And that's where the return comes out over a long enough period of time. If that money is reinvested in growth and it's good quality growth and the CEO does a good job, you end up with a business that has a higher share price because of that value creation.
Cool. And we're running out of time. We could talk all day on this. So I thank you, Scott. So everyone go check out the Motley Fool. Follow Scott on every channel if you can, and make sure you give the gift of investing this Christmas with the Sharesies gift voucher. But thank you, everyone, for your time today and watching our shiny heads talk to you about the previous year and the forthcoming one. We'll also be answering some of the questions that we didn't get to on social and stuff. So stay tuned, everyone. Have a wonderful break and see you next year.
Thanks, Brendan. Thanks, everyone.